SCHD is in the middle of its longest losing streak ever compared to the S&P 500. Since 2022, it's dramatically underperformed, and the last year hasn't been great either, down 6.22%. The growth of the dividend has even started to slow down, which was one of its main attractions. The top holdings are starting to look kind of boring, and investors are starting to wonder, is SCHD broken? Today I'm going to answer the question, is SCHD actually failing, or is this exactly when the right kind of dividend investor should be looking to buy? If you stick around to the end of the video, I'll explain exactly what made dividend investors fall in love with SCHD, and I'll even share a look at how it's performed if you bought it at some of the worst possible times. My name is Zach, this is Dividend Data. I build research tools to help dividend investors actually understand what they own. In this video, we'll break down SCHD's price performance compared to the broader market, things like the S&P 500. Plus, we'll be sure to look at total return, since dividends are a big part of your long-term return as an investor. I'll take a detailed look at SCHD's dividend and why its growth seems to be slowing down. That will include a full picture look at the ETF strategy, the companies they own, and what sectors you're investing in. After all, if you're long-term investing in an ETF like SCHD, you have to actually understand what you're buying. Plus, I'll do a simple $10,000 growth test so you can actually see the results that long-term investors have been having with SCHD. At the end, I'll give you my honest take. Would I buy SCHD today? What I choose to do with my investments? And for the average investor, whether I think a strategy like SCHD is better or just to go with S&P 500 based ETFs like VU. And ironically, a lot of that has coincided with the exact same time that SCHD has become insanely popular. Let's start with what's going wrong. So you can see over the long term, there has been growth at SCHD. But as we focus in on the past 5 years, the story starts to become a little different. The price really hasn't gone anywhere while we're in the middle of a bull market. Year to date, SCHD is down 0.95%. The 1-year price return is negative 6.2%. And the 3-year price return is only 5.97%. This is massive underperformance going back to 2022. We can compare this to something like the S&P 500, of which there's many indexes you could buy. A popular ETF, though, is the Vanguard S&P 500 ETF, ticker symbol VOO or VU. That ETF is up 13% this year and up 68.8% over the past 3 years. And this outperformance has a lot to do with the actual companies that make up these ETFs. After all, when we're investing in the stock market, we're investing in businesses. The S&P 500 is now 35.7% technology, and the top holdings are the big tech companies, which are some of the best businesses in the world. Things like Nvidia, Apple, Microsoft, Amazon, Broadcom, Alphabet, Meta, Tesla, etc. And the other big factor to consider here is that most of these companies are AI-related businesses, and a big part of this story to mention is that if you were invested in SCHD, you would have missed a lot of the growth that big tech had in that time. This underperformance has had a lot of dividend investors wonder if SCHD is dead money. Now, to be fair, us dividend-minded investors understand that a big piece of long-term compounding actually comes from the dividends and reinvesting those payments. And in that time, you would have gotten close to a 4% yield on your SCHD investment, and you were getting paid far more dividends compared to the S&P 500, 4% versus 1%. So let's do a comparison of the SCHD total return with the VU total return. And the dividend actually didn't even help that much. The S&P 500 has kicked the butt of SCHD. From the exact date I'm making this video, November 17th, SCHD has a total return of 18.4% over the past 3 years. That is a 5.8% compound annual growth rate. The S&P 500, on the other hand, has a 76.3% total return in that time, which is a 20.8% compound annual growth rate. So on the surface, it looks like maybe the strategy has stopped working. But before we jump to the conclusion that SCHD is broken, we need to look under the hood. Why are people buying SCHD? What is the goal and strategy of the ETF? And what would it take for SCHD's future total return to more closely match the S&P 500 or potentially even outperform it? So why are people buying SCHD? Well, they view it as a simple and low-cost method to buy a diversified basket of dividend stocks that will continually pay them growing dividends over the long term. And they know that if they reinvest those dividends, it could have a compounding effect. The dividend snowball is something I often cover on the channel. Plus, this could one day be a source of income that they could use to retire. So in order for SCHD to be truly broken, it would have to break away from that goal. We would need inconsistent and unreliable dividend payments, the dividend being cut or going backwards, a move to higher expense ratios for the fund. Right now, SCHD has a 0.06% expense ratio, which is basically your annual fee for owning the ETF. This is extremely low, and it's really only comparable to those S&P 500 low-fee ETFs, like VU, which I mentioned earlier. So is SCHD breaking any of those stated goals? No, and it doesn't necessarily seem like they're going to. Here you can see the full dividend history for SCHD. Over the trailing 12 months, they paid $1.03 of annual dividends. On a forward-looking basis, it's on pace for $1.04. That's based on the most recent dividend payment. That would give it a 3.86% forward-looking dividend yield. The 10-year compound annual growth rate is 11.25%. So over the long term, this has been a dividend grower. Even over the past 3 years, the 3-year CAGR is 7%. However, over the past year, we're at 3.5%. So that is a slowdown at the moment. That could be a warning sign, but we're still trending towards long-term growth. The other key difference here is that compared to individual dividend stocks, the payment's not always consistent, which is something I like to look at with my own methodology. I try to focus on reliable dividend growers. So from the dividend perspective, SCHD is not broken. For the expense ratio, SCHD is not broken. It's still 0.06%. And one of the most important things for individual investors is to find low-fee investment vehicles, because those can really start to eat away at your long-term compounding. My main concern with SCHD's dividend is the slowing growth and whether or not that ends up being the expectation and normal trend going forward. We'll talk about that in a bit. Now, some of you may have gotten used to that 10% plus annual dividend growth, but a near 4% dividend yield with 4 to 7% annual dividend growth, that can still build up to be a serious income stream for you. After all, this is passive income for your portfolio. Many use it as a retirement strategy. And most people at their job, they aren't getting 5 to 7% raises annually. Growing passive income is certainly appealing to many. And if you reinvest that while you're still working, it can be a pretty powerful total return. In a few minutes, I'll show you exactly what that would look like if you had invested $10,000 in SCHD, and I'll give you cases based on different starting points. But we have one other big thing that we have not covered related to SCHD, and that's the stated strategy of the ETF, how they decide what holdings they own. Because as I mentioned earlier with the S&P 500, we are ultimately just investing in businesses, and the returns will follow the growth and valuation of those companies. So what is the methodology of SCHD? Well, the primary goal is to track the total return of the Dow Jones US Dividend 100 index as closely as possible before fees and expenses. That index tries to focus on the quality and sustainability of dividends, selecting stocks based on fundamental strength relative to their peers using financial ratios. That includes several factors like consistent dividend payments for at least 10 consecutive years, positive earnings over the past 12 months, and low debt to equity ratios. So basically, they just have a methodology to select high-quality dividend stocks. And when you're investing in SCHD, you're getting a basket of those companies, and they rebalance this quarterly. So what does SCHD look like right now? It's spread across more than 100 holdings. The top one is Amgen, ticker symbol AMGN. And if we take a look at that, this is a long-term dividend growth stock. You can see it has compounding earnings and stock price has grown over the long term. And this itself is a dividend growth stock that has a 5-year compound annual growth rate of 8.27%. The current dividend yield is 2.79%. And SCHD is full of a lot of these kinds of stocks, whether it's Cisco, Merck, AbbVie, Coca-Cola, Bristol-Myers, Chevron, PepsiCo, ConocoPhillips, Lockheed Martin, Verizon, Home Depot, the Altria Group, Texas Instruments. You've seen me talk about many of these companies over the years. So really what SCHD is doing is it gives you a simple solution to buy into these more reliable dividend stocks that continually grow their payments. And if we look at the diversification, you can see it's 19.7% energy. I had stakes in companies like Chevron, ConocoPhillips, EOG Resources, I covered that once. The second largest weighting is consumer defensive. That includes things like Coca-Cola, PepsiCo, Procter & Gamble, your consumer staples. Third is healthcare at 15.6%. And we have to keep going down to get to technology. Technology is just under 10% of SCHD. And a lot of the best big tech companies don't fit the criteria that would get them selected into SCHD. They don't have 10 plus years of consecutive dividend growth. And it's really this choice that has led to SCHD's underperformance relative to the S&P 500 or the NASDAQ 100. And your question as an investor is whether or not you're okay with that. SCHD is not going to own NVIDIA. It's not going to own Google. And this is why it's important to know what you own as an investor, because it starts to put into context why SCHD is underperforming. It doesn't own any of the stocks that are driving the market up. Tech is over 30% of the S&P 500, and it's 10% here. So SCHD isn't broken, it's just playing a different game. So now I'm going to explain what you can expect as a total return going forward with SCHD, under what scenarios it could do well relative to the S&P 500, and what a $10,000 investment in the ETF would have grown into, whether you bought it when the fund started, or 10 years ago, 5 years ago, or even during this bad period 3 years ago. Plus, I'll explain who SCHD is and isn't for, and my personal opinion around SCHD. By the way, everything I'm showing you today, the dividend history, the sector breakdowns, the total return comparisons, this is all inside dividenddata.com, the platform I built specifically for dividend investors. We just rolled out a huge update earlier this year that allows you to analyze ETFs, mutual funds, and international stocks. We went from 8,000 US companies you could analyze to now over 80,000 options. And for ETFs, you can see the dividend yield, the expense ratio, the historic dividend payments and growth summaries, plus its holdings. So if you own SCHD, VU, and other dividend ETFs, you can analyze and compare them within our platform and compare them side to side with your individual stocks. And if you know me, I'm an individual stock kind of guy, and this is the ultimate research tool to help you understand the full business behind the stock. And of course, with a key focus on the dividend. So if you want to try out dividenddata.com, right now is the best time you can. We have our Black Friday sale, which is now live. You can lock in 50% off annual memberships because investing, it's a long-term process, and we're building a tool that we want to be with you over the long term. If it helps you find just one better stock or investment, then it way more than pays for itself. So use the link in the description or pinned comment of the video to get that Black Friday sale, and you can follow along and use the tool that I use. Okay, so let's get back to SCHD. So what happened if you had invested in SCHD over the long term? If you had invested $10,000 in the inception of the fund back in 2011, and you had reinvested your dividends, that would now be worth over $50,000. That is a 403% gain, or a 12.2% compound annual growth rate. So yes, SCHD has underperformed recently, but compared to not investing, this is still a great option. And even in the market, there are many things you could have done that would have done worse than 12.2% annually. I personally wouldn't even have my expectations being that high for something like the S&P 500. But let's look at how it did over the past 10 years. If you had invested $10,000 in 2015, that would now be worth over $28.5 thousand. That is a 184.2% total return, or a compound annual growth rate of 11%. This is assuming you were reinvesting dividends, and it would be generating a lot of annual income. If you had invested $10,000 in SCHD 5 years ago, it would have a total return of $15.38 thousand. It would now be worth $15.38 thousand, which is a 53.8% return, or 9% annually, even if you bought it at the worst time in recent history, fall 2022, where it started this long stretch of underperformance. If you had invested $10,000, you'd still be positive and have $11.8 thousand, an 18.4% gain, 5.8% compound annual growth rate, plus passive dividend income that's growing every year. Could you have done better investing 100% in tech stocks? Yes, you would have absolutely crushed this. But this is a dividend ETF. And does it look broken as a dividend ETF? Not really. And investing in general can deliver great long-term compounding results. If we take the current metrics for SCHD, and we only assume 5% annual dividend growth and 5% annual stock price appreciation, and let's say you wanted to invest $1,000 a month at that, and you're going to reinvest all the dividends earned, that would still have serious compounding over the long term. By the end of 35 years, that would be a portfolio of $2.6 million, paying you $91,000 a year in annual dividend income, and this would be a simple path towards that goal. Plus, there could be months and years where you do outperform the S&P 500, and all it would take for that to happen is for these big tech companies to have their stocks sell off and underperform. And you do hear a lot of talk about a potential AI bubble, but this is not the video for me to be diving into all that and my take on that. But in theory, that's all it would take for SCHD to outperform relative to the broader market, because they don't own any of these stocks. And by the way, this is assuming you're reinvesting your dividend income throughout that period. because that is a big part of the dividend snowball, and the difference between reinvesting your dividends and not is huge over the long term. So is SCHD broken? No. But what's broken is the expectation that people think it should be outperforming the market at this time, given the fact we're in a bull market and all the big tech companies are seeing big earnings growth and a lot of potential growth on the horizon with the AI wave. SCHD does not play into any of that. So what kind of investor is SCHD right for? If you're looking for a simple solution for investing, you just want one or a few ETFs in your account, set it and forget it, automatic investing every single month, you just put money into it, and you don't want to think about it at all, this potentially is an interesting option to at least have as part of your portfolio, especially if you find the idea of having dividend income attractive to you, a much higher starting yield than the S&P 500. Honestly, your dividend growth may be higher than the S&P 500. If you want exposure to some boring, reliable companies and a big diversified basket of these cash generators that have reliable growing dividends, and if you want to be on autopilot, SCHD could be a good option. And frankly, that's why it's become so popular. Some people aren't really that into investing, not to the degree that they want to analyze individual businesses. And with ETFs like SCHD, you can just forget about all of that and just focus on your personal finances, trying to increase your income, save as much of it as you can, and invest that into the market. And you just play the long-term game, focusing on your own personal finances. And frankly, this strategy, not specifically talking about SCHD, but ETFs in general, whether it's like VU, the S&P 500, for the average individual, that's probably the best approach. Just dollar cost average into the market across a few diversified funds. SCHD is an understandable holding to have, but you got to understand what it is, what you're buying, and why you're investing in it. Now, personally, I do not own SCHD. I invest in individual stocks, and I like doing a ton of research into my holdings. I am more tech heavy, but even people who invest in individual stocks, many like to have a portion of their money put in ETFs as well. And if you want a great platform to track your investments, your dividend income, and research ETFs and stocks, you can do all of that within dividenddata.com. We just added ETFs over the past few months and a bunch of international stocks you can analyze. We 10x'd our coverage, going from 8,000 to 80,000 potential options. And right now is the best time to join because we have our Black Friday sale where you can lock in 50% off annual membership. Just click the link in the description and pin comment if you want to try that out. With that said, thank you for watching, and I'll see you in the next video.